Welcome to the third video of Masterclass series where we are going to learn the investment philosophy of Mr. Raamdeo Agrawal, who is Joint MD, co-founder and chairman at Motilal Oswal Financial Services Limited. He is considered a renowned value investor and believes in power of compounding. He has a consistent track record of highest integrity in tax paying for 5 years. And the audience would be glad to hear that he follows Warren Buffett and his ideology is exceptionally based on him. Through the course of the video, we will see the following concepts and understand his investment ideology. So now I would like to pass on to Kamal to explain his idea generation.
Ideologies on which Raamdeo sir has invested upon companies. Like you can see, these are the ideologies which Raamdeo sir has used, like financials and fundamentals, companies fitting in the QGLP. We are going to discuss QGLP in much more detail, but here I am going to give a brief introduction. But before that, I want to introduce the ideologies. Third, companies moving with changing trends. You can simply understand it by value migration. Fourth, dividend policy of company. And fifth, learning from Warren Buffett. So here I want to give a brief introduction to the QGLP framework. We are going to understand how we can judge quality of business and quality of management by the governance over the operations the business have, competitive advantage, and any fraudulent activity has done by the management or not. Second and third is growth and longevity of growth. The growth should be sustainable in nature. It should not come due to the short-term change into the realizations of the business. It should come from the any kind of a thing like the company is getting into the value-added segment. So because of that, the growth of the business is sustained for a longer time. The growth determines by the growth of the profitability, but not only profitability, but it should also get converted into cash. And the last is reasonable valuation. In any kind of an investment, valuation is the most prominent thing, because if the price of the investment is overvalued, then that investment is not so much worth to make. All investments should have the price which can be very competitive, not competitive, but it can be very rational to make. And now for further explanation, I want to invite Purva.
So now let us look at Raamdeo sir's perspective on fundamentals of a company. Here, Raamdeo sir wants us to recognize the tailwind of different business cycles, which is a major reason for entrepreneurs to grow, as they get exceptional growth at their businesses fueled by the environment they are in. Price in the short term may tumble, but in the long term, it catches the actual value of the business. Search and invest in the sector which are yet to come in its prime. Then wait for the market to turn in your favor. Hold the share until the potential recognized or the company loses its growth, and do not get emotionally attached. On the valuation front, Raamdeo sir mainly focuses upon PE and EPS of a company. Next, is the leverage serviceable? The next is, does the management of the company have future growth plans and the horizon that the management have about the industry? The potential growth of the business and the industry. The last is disruptions that are probable, especially Raamdeo sir wants to stay away from the effect of Chinese products and digital transitions. So now let's look at the PE re-rating concept. Here is an example where the earnings is 1,000, PE is 10, thus the market cap is 10,000. Now, when the earnings double, PE remains constant, the market cap rises by 100%, while percentage change in PE is none, and the percentage change in earnings is 100%. While for the third situation, where the earnings double as well as PE doubles with the change in market conception, for the third situation, where the earnings double as well as the PE double with the change in market perception, the market cap increases by 300%, while change in PE is 100 and change in earnings is also 100. There is a compounded effect on the market cap. For the fourth situation, when the market considers the growth sustainable and gives a greater PE, where the PE increases by 150% while the earnings growth is just 100%, there is a compounded effect on the market cap as it increases by 400%. So now let us look at valuations of a company during market momentum. Here is an example where the earnings future expected growth rate is 20 and the present value of the upcoming 5 years is just 6,450, while the PE given during the momentum is 30 and the share price there was 30,000. Hence, the ratio price to present value of earnings of the next 5 years is 5. Thus, even if we are invested for 5 years, we may not be able to gain profits just on the basis of earnings growth. So now let us look at the upward averaging concept. Here, you increase your exposure to a stock when the stock price rises. This happens when your conviction about the company rises and you increase your exposure to the stock. Now, let us see at the benefits. First, we only enter the stocks that are already winning. It brings you at the forefront of a rally. That is, you could enter the market at low prices and then enjoy the rally. Avoid a trap. Upward averaging is the opposite of downward averaging. But what if the stock never recovers? Avoid a trap. Upward averaging is opposite to downward averaging, while in downward averaging, there is a possibility that the stock may not ever recover the same levels. Fourth, get a multi-bagger stock. You get a multi-bagger stock. Now, let us look at the numerical here. When the stock price increases from 100 to 130 and you go on increasing your exposure to the stock, the average price increases to 116, but it is not as high as 130. It is a decent average and you are still into profits. Upward averaging is only beneficial when done in a decided price range or the stock could be overvalued at times.
So let us take a look on the QGLP framework which Raamdeo sir uses. Now here, Q stands for the quality of the business and management. G stands for growth in earnings and sustained ROE. Longevity, how much long the business can sustain in its game and what is the price that you are willing to pay for it. Now further, quality business is the one with competitive advantage with high return ratios. Further, it has industry leadership position. In addition, they have a favorable industry structure that is operating in monopoly, duopoly, or oligopoly. Also, such business models are secular, stable, consumer-facing, and most importantly, they shouldn't be having much debt on their balance sheet. Now, quality management. They are competent, which can be seen in the high leading margins that they command. Their capital allocation is very rational, which can bring them good returns on that capital employed. They believe in rewarding the shareholders with regular dividend. They think out of the box innovatively for products, processes, and selling process. Mainly, they are transparent in dealings and about their disclosures. Now, second is growth. To know a business that is growing, they should be in a large addressable market. Their goods or services should address various needs of the market. The company should be gaining market share. The growth should come from profitable segment. And lastly, that growth should be sustainable. So here is how the graph can be if we plot quality here and growth here. So the one from low to high on both these axes, the one which will stand here, that is high growing business and quality business, will be a multi-bagger for us. Coming on to longevity. Longevity is the sustainability of excess return by company. A major task is to assess how long a company can keep earning above its cost of capital and can continue to find productive investment opportunities. Longevity can increase if it has a competitive advantage and a competitive edge over others. It has growth potential and many more factors. So the last being the price, that what is the price one should pay for a business. So coming to price, a price of a stock has to be seen in conjunction with the value that it offers, because price is what you pay and the value is what you get. And being Indians, we always want sasta mal, right? Jokes apart. So stocks are attractive when they are priced less than the value perceived in the stock. Pricing can be evaluated by some of the metrics like PE, PB, PEG, DCF, etc. Coming on to the next slide, Raamdeo sir segregates quality of businesses into good, great, and gruesome. In good kind of companies, the return on tangible assets is high. In great companies, high returns are there, but when they employ additional capital, on that incremental capital also, they are able to earn high returns. What are gruesome companies? So these are companies which are earning less than the cost of capital. So in spite of trying to grow, they tend to destroy the capital. Now, in the nature of businesses, these great kind of companies, they have a very stable business, and much changes and if much changes happens, then they do not tend to get affected by them. The good kind of companies might face some problems due to those changes, but they will try to cope up with those, and the gruesome ones might be impacted much. Now, competitive edge. Now, great kind of companies have a moat either in their products or in their marketing strategy, which differentiates them from these two. So as they have moat, they have high pricing power. And here, both of these companies might not have that much pricing power. The capital intensity. So great kind of companies tend to have a higher turnovers, as they might be able to charge more price, that is high realizations, and high realizations might bring good revenues. So they might have high turnovers. Here they might have moderate to high, and here they don't have much of the turnovers. So for ROEs, the companies, great companies might be having a high ROE or a rising ROE. In the good companies, the ROEs are stable and they are in an increasing phase too. And here there are low ROEs or falling ROEs, maybe because of much of the debt they have taken. They might not be able to address the market. Their market share is declining. Okay. So here dividend payouts, typically it is high, here it is reasonable. Here might be due to losses, they wouldn't be paying much dividend. And further are the examples that HUL and Nestle are termed as great companies. HDFC Bank, DMart, they are termed as good, and the following are termed as gruesome.
So now we're going to start with value migration and networking effect. Value migration. Value migration is the shift of trend in an industry caused by new technology, change in consumer preferences, or any other reason. The smartphone industry, it evolved from fixed telecom lines to wireless phones and at last smartphones. The shift in the trend was because the later product outdated the previous one. These shifts happen when they are timed perfectly, has a scope to grow, and is cost efficient. But the most important thing is the quality of the product. All three of these aspects revolve around quality. Let's say EV was in an era where electricity was not available everywhere, or smartphones were in a place where there were no networks or were so expensive that no one could afford them. But the most important thing is quality. Networking effect. It is where the market leader has more than 70 to 80% of the market share, as they have the strongest consumer base, more active user, more feedback and data, better user engagement, and higher organic growth. As customer base is high, their cost goes down, which increases their profit margins. For example, companies like Bharti Airtel and Hero Honda benefited from value migration and networking effect and gave them tremendous growth. As you can see in the graph, how Bharti Airtel's revenue, EBITDA, and PAT has grown exponentially, and so has its market cap.
So now let's begin with the dividend payout and dividend yield ratio of companies. Dividend is one of the two ways to pay back the shareholders. The benefits of dividend are that they provide a constant income to the shareholders, reduces risk volatility, especially when a company is brought at its trough. Over the years, dividend can cover the cost of capital in case of companies who take a longer period to provide returns in terms of valuation. Sometimes PE is also defined as dividend payout upon dividend yield. Dividend payout further is dividend paid upon earnings per share, and dividend yield is the ratio between dividend paid and market price. As we can see in the chart, the highest dividend paying companies of India. Now let's understand this concept numerically. In the first case, we can see the market price of a company is 100, EPS is 10, dividend is 2. Now, as we all know, PE is market price divided by EPS, which makes the ratio 10. Dividend payout ratio we discussed in the previous slide being dividend divided by EPS, which makes it 20%, and dividend yield, dividend divided by market price, makes it 2%. Now, in the next case, everything being constant, the dividend has risen to 4, which makes the dividend payout ratio and dividend yield twice, that is 40% and 4% respectively. But as Raamdeo Agrawal sir says, market does not leave more than 2 to 2.5% dividend yield on the table. Thus, in the quarter 3, we can see that the market has corrected itself to market price being rupees 200, thus bringing back the dividend yield 2%. As we can see, the EPS has not increased, but the market price has increased, which led to PE rising to 20. We can see dividend yield depends on dividend paid, but the market price depends on market sentiment. Thus, in order to get the yield back to normal, market reacts and gets the market price doubled. Now, next we will see Warren Buffett's style of investment, and I would like to welcome Kamal.
Now here we are going to understand Warren Buffett's style of investing. First, you should not diversify your portfolio so much because it will become a tedious job to focus on a lot of companies. You will not able to make an investment which much more care if you will diversify your portfolio so much. Second, you should invest into the industry which you understand. If you not understand the industry well, then any kind of things which is happening into that industry, you will not able to take the decisions about that thing with utmost care. Third, management should be intelligent, energetic, integral, and trustworthy. If the management is not effective and efficient, then maybe it will destroy your wealth into that company, because maybe the management will not able to take care of your wealth, or will not able to operate the business operations efficiently, because maybe the management will not able to allocate your capital with utmost care, and because of that it will lead to a loss into capital. Fourth, a very good company at a high valuation is bad investment. If any kind of a investment you are making, you have to first take care that the valuation should be reasonable. If it is not, then you end up paying so much high valuation to an investment which it doesn't deserve. Fifth, discipline and patience gives investment time to grow. Like you have heard about the Warren Buffett's wealth creation, how over the years his wealth has compounded on 15 to 20% CAGR. 6, one should stay away from the bubbles, no matter how lucrative the market momentum looks, as it destructs value on busting. You have heard about the story of 2000 tech bubble crash. Into that crash, the people who had invested into that company at the peak of that boom, they have ended up making so much losses which they didn't able to recover from it till now. Now I want to take you to the case studies. These are some of the companies into which Raamdeo sir has invested during these times, and the reasons were common, like investment which was made was done at very low value, and you can also see that the major common thing is that these companies value migration has happened, not only in that company but also in that industry as.
So, coming to the end of this series, we learned many valuable insights from these wealth creators. For example, buying companies at low valuation, focusing on capital efficiency, quality of management, investing during crisis or contra investment, focusing on growth potential of companies, and learning to understand business cycles. So now we would like to take your leave and see you in the next video.